Hi, my name is Sabit and welcome to this video on depreciation, where we will explore how we count for asset decay. Let's start with a very quick recap on non-current assets. We need to distinguish between tangible and intangible assets to understand exactly what we are spreading the cost of. Assets are broadly classified into tangible assets under IAS 16 and intangible assets under IAS 38. While land has an infinite or unlimited life, which is not depreciated, but almost all other physical assets are depreciated. For intangibles, we use the term amortization to allocate their cost over their useful life. So, why do we depreciate? It comes down to a Crewell's concept. Depreciation is not about market valuation. It is a systematic way to match the cost of an asset to the revenue it helps to generate over the useful life. There are two main types of depreciation. The straight line method is for assets providing steady benefits, like buildings. The reducing balance method is for assets that are more productive in their early years, such as technology products or high-value cars. Consider a pizza oven costing £40,000 with a 15-year life. By spreading that cost, we avoid charging the entire expense in year one, allowing for a more accurate representation of the annual profit. As you can see the differences from the extracts. Therefore, depreciation relies on management estimates. We must determine the useful economic life, the expected residual value at the end, and the depreciation method that best reflects the asset's usage. Let's look at a logistics van with a cost of $30,000 and a residual value of $5,000 and a useful life of 5 years. We have the core data needed to calculate its depreciation. Using the straight line method, we subtract the residual value from the cost and divide by the useful life. Here, that results in a consistent annual charge of £5,000. The reducing balance method applies a fixed percentage to the net book value each year. This leads to a higher depreciation charge in the early years and lower later, which is ideal for tech-heavy assets. When applying a 40% reducing balance rate, the depreciation expense decreases annually as the net book value of the asset declines, moving from $12,000 in year 1 to $4,320 by year 3. This table illustrates impact on the profit before tax. You can see how different depreciation expenses fluctuate between methods, ultimately affecting the bottom line figures. Recording the entry is straightforward. We debit the depreciation expense in the profit or loss account to reflect the usage, and we credit the accumulated depreciation to show the running total in the statement of financial position. Finally, for high-value assets like aircraft, depreciation is a massive factor. Here, £100 million aircraft with a 5-year life results in a £20 million annual depreciation expense. This schedule details the 5-year depreciation process for our aircraft. It tracks the opening net book value, the constant $20 million annual expense, the growing accumulated depreciation, and the remaining carrying value, which reduces zero by the end of 5 years. Looking at the financial statement extracts, the annual $20 million charge reduces our operating profit consistently. Simultaneously, in the statement of financial position, we see the carrying value drop by £20 million each year until it's fully depreciated. Accounting estimates aren't set in stone. If management reviews the aircraft usage and decides it will fly for 10 years instead of 5, and can be sold for £5 million by the end of its useful life, then we apply the change in estimate prospectively from the start of year 4. So, with the remaining net book value of £40 million at the start of the year, and the new residual value of £5 million. The remaining £30 million is the spread over the next 7 years of the remaining life. These adjustments lowers our annual depreciation charge to £5 million. Because estimates are subjective, they can be used to manage earnings. In this case, extending the aircraft's life effectively inflated the year 4 profit by £15 million. Therefore, accounting standard requires annual reviews of these estimates to prevent such manipulation. In conclusion, depreciation is a systematic allocation of most physical assets to match the revenue it helps to generate. If you have any questions, please feel free to leave a comment or get in touch. Thank you very much for listening.